This is All India Radio. In the program Spotlight, now we bring a discussion on prospects of economic growth, GST collections and increased FDI inflows. The participants are Eka Bhattacharya, economic analyst and AIR correspondent, Arjun J. Chaudhary.
Mr. Bhattacharya, let's begin by understanding what the turnaround in the economy has been, where we saw in the first quarter the GDP growth had fallen by 23.9%, reviving into the second quarter with 7.5%. Now we also have the goods and services tax, the GST collection for the last 2 months, October and November, the collection being more than 1 lakh crore rupees for both the months, and then we have foreign direct investment figures for the second quarter, which has gone up by 140%. Total FDI is estimated at $28.1 billion US, which includes, of course, equity inflows, reinvested earnings, and other capital. What has really led to this U-turn and a complete overhaul in the economic indicators for the economy?
The Indian economy, thanks to the COVID-19 pandemic and the economic lockdown that was imposed in its wake, saw a contraction of around 24% in the first quarter. And as the economic lockdown was being phased out in the second quarter, the expectation was that the economy would still contract, and there were various estimates during the rounds ranging between 10% contraction to 15% contraction. It now turns out that the contraction in the second quarter is only about 7.5%. This means the economy, which was earlier feared to be contracting at a higher pace, is now contracting at a lower pace. The dangers are not gone, but clearly there are early signs of recovery, which shows that the first half of the current year, instead of the earlier fears of a huge contraction, the first half is only 15% contraction. This is not something that you can celebrate, but certainly you can seek comfort from in going forward. In what way? Look at the various data points that you are getting with every passing day. You mentioned about the GST collections. You talked about the FDI inflows. Remember, the FDI inflows in the first quarter were down by 60%, and in the second quarter they bounced back. So in the first half of the current financial year, FDI flows have seen an increase of 15%. The GST collections, which reflect the indirect taxes collected on transactions in the previous month, have now have reached a level of 1 lakh crore plus for 2 consecutive months, which means that the transactions in October and the transactions in November have been quite substantial to have given the government overall GST revenue of more than 1 lakh crore. Are they sufficient? No, they are not sufficient. They need to be little more, say at around 1.2 lakh crore or so, if you wanted to meet the target that was set before the year began. Look at the car sales. October saw a good increase of a double-digit increase in car sales, but November has seen a small increase, but nevertheless it is an increase. So you might say that the festival saw a huge clearance of sales because of pent-up demand, but November has also held on to those sales, so which is a good sign. What does the future hold for us? I would say that it is very important to sustain this recovery and make the recovery very stable, so that the remaining 2 quarters of the current financial year hopefully report not a contraction but an increase in the growth rate. The Reserve Bank of India has actually indicated that maybe the third quarter itself sees the economy returning to the growth phase, and the fourth quarter everybody is agreed that we'll see growth phase. If you look at the government's fixed capital formation for the second quarter data, which shows that the investment rate has gone up to 29% of GDP. Look at the unemployment rate. It has come down to a level which is lower than what used to prevail before COVID-19 started impacting the economy in March. So if you look at the various data points, there are enough numbers to tell you that the economy is on the mend. How fast and how quick, how stable and how sustainable that recovery would be will depend on a variety of other factors.
from the month of June onwards, the GST collection has been 91,000 crore rupees, and it wavered in July to 87.5, August 86.5, September 95.5, and then finally in October and November it's crossed the 1 lakh crore rupee collection. You expect that it should be 1.2 in quarter 3 and quarter 4. Foreign direct investment has also gone up. It had contracted earlier in the first quarter in comparison by 60% and then went up by 140%. What is the sentiment of the business community, and do you see consumer spending really picking up, or is it just pent-up demand that is driving the economy right now? Is there any discretionary income on the part of consumers and businesses who are looking to spend in the economy so that production, and more specifically gross domestic product, is technically able to come out of its recession going into quarter 3 and quarter 4, so that not only is the GDP figure in the 5% range, but it also meets its fiscal deficit target?
Well, 2 points. We have to watch inflation. There are signs of the retail inflation increasing. It has already crossed the 7% mark. The food inflation is even higher. So therefore, one has to keep a check on inflation. With high inflation, whatever tendencies people have of spending more actually gets tamed. So one has to be very watchful of the inflation trajectory, particularly at a time when the Reserve Bank of India will be encouraged to lower the interest rates, but it cannot lower interest rates because of the inflation rate. So therefore, inflation must be tamed, and this is a little unusual because normally when you have a recession, inflation is not really a problem because there is no demand, where is the question of prices going up. But this is an unusual situation that we are seeing, that we are technically in recession and yet inflation is rising. So one has to be very watchful of inflation and making sure that there are no supply bottlenecks which come into the way of meeting genuine demand in the economy. That's number one. Number two is very important that the investment cycle is revived, because infrastructure bottlenecks can cause problems in meeting and reviving the economic activity pace in the manufacturing sector in particular. The good news is that the corporate sector, the second quarter, has seen large increases in its bottom line, even though its sales haven't done very well. So which means the corporate sector is making money, which hopefully it will recycle that money in fresh investment. And the early signs seen in the second quarter GDP numbers, which tell you that the gross fixed capital formation, which is the investment rate, has gone up to 29% of GDP, is a good sign. The third point, which is quite important for sustaining this recovery, is the general risk aversion in the economy. The risk aversion in the economy can be problematic because even if the growth drivers are there, investments are there, you need to shed the current risk aversion to revive demand. One clear sign of that risk aversion is evident in the manner in which the household savings have seen a record increase in bank deposits in the last few months. Now, which means that people are investing more in safe areas. If you were to ask me that why the stock market is booming largely by the foreign portfolio investments. So the domestic retail buyers, the retail domestic consumers, are seeking the comfort of their saving bank deposits schemes, and that shows the risk aversion has not gone completely away. So you need to tackle inflation, you need to dispel this risk aversion and bring back the so-called animal spirit in the market so that people, consumers, come back and start consuming and spend more, which will produce a kind of a virtuous cycle to revive demand, revive investment, and eventually, your question, revive growth.
So when you talk about the rise in prices of essential goods, inflation, looking at CPI and wholesale price index and its linkage to interest rates, that's your response to the first question. That's also going up, and we're also seeing some instances of predatory pricing by financial institutions. We're seeing the growth or the revival in the economy led by corporate profits, but not in terms of wage levels. Do you see that as an incentive for foreign direct investment into the economy? Whenever we look at offshore outsourcing, especially looking at manufacturing, and even if you look at the PMI for manufacturing, it has been plus 50 for the last 4 straight months. The index for industrial production has seen meager rise. where, of course, if you look at this indicator, 3/4 of the weightage is in manufacturing. So do you see lower wages as an incentive really for foreign direct investment into the economy, which will eventually lead to higher wages and development in the economy?
Major source of reviving the economy would certainly be the foreign direct investment, because the domestic companies' capacity utilization levels are still not very high, which means that 65 to 72% capacity utilization level, the domestic industry is not encouraged to invest more in creating fresh capacities. They would rather like to use their existing capacities for meeting the demand in the economy. So therefore, the trigger has to be the foreign direct investment. The FDI inflows have seen an increase in the first half of the year of around 15%. Now this money has gone in largely for brownfield investments, which means companies that already are existing. In other words, they have led to shares have been purchased. So therefore, existing companies have taken advantage of the foreign money to expand or reduce their debts or increase their spending capacity or investment capacity. Ideally, if this FDI had been directed or channeled more to greenfield investments, which would have had a bigger spin-off positive effects on the economy. But even when you are investing in brownfield investments, it does mean deleveraging the existing companies from debt. It also means that the existing companies can expand at a faster pace. So therefore, FDI is clearly route that we must exploit, and I think the Indian economy has seen that trend. Even when the cheap money is available, liquidity is flush in the global economy. A lot of the US markets, the central banks are at a zero-rate interest regime. So a lot of money are likely to flow into the emerging economies like India. But even such money is actually getting directed less to the stock markets and more to the FDI route, the private equity route, through the sovereign wealth fund, etc. Therefore, we have to tap into that source of money and use those investments to create extra capacity and build small infrastructure projects which facilitate and lubricate economic activity and also create local jobs. So therefore, FDI certainly, as you said, is a definite instrument for reviving growth in the days to come.
Well, you spoke about the source of investment when we talk about foreign direct investment or FDI. So Mauritius has been a key tax haven from which we are seeing a lot of inflow of foreign direct investment. And this is now followed also by the United States of America. Now, how do you see these two largest democracies working together across sectors, including defense and consumer-based industries?
With Mauritius, I think the recent decisions to plug some of the double tax avoidance agreement loopholes, we have seen a shift away from Mauritius as far as the foreign direct investment sources are concerned. You are now seeing Singapore emerging as the single largest source of India's foreign investment in the last few years. So Mauritius, which used to be looked at little, not suspiciously, but some question marks on them because they may be coming from either recycled or rerouted investments. But now that problem is by and large has been tackled. As far as the US is concerned, I think after the election victory of the Democratic candidate, Mr. John Biden, you will see a new regime, and India will have to use that opportunity, not just for investment, but also to build the US as a major market and partner in its trade. India has had some difficult moments with its US trade policies, in the sense that India was taken off the list of the GSP countries. So that was a big setback. Hopefully all these irritants will be tackled and US will become a bigger economic partner in India's march in economic arena in the coming years.
Well, thank you so much, Mr. Bhattacharya, for being with us on this program and giving us your valuable expertise on what the prospects of economic growth in India are, and looking at what the GST figures have been for the last 2 months and the growth in FDI by 140%, what it means for India now and in the coming future.
Thank you.
You were listening to a discussion on prospects of economic growth, GST collections, and increased FDI inflows. The participants were A.K. Bhattacharya, economic analyst, and AIR correspondent Arjun J. Chaudhary. This program was produced and presented by the News Services Division of All India Radio. You can listen to it on our mobile app, News on AIR. This program is also available on our website, newsonair.com. You may email your opinion about this program at airnsttalks@gmail.com.